Swayam Prabha. Digital India. Educated India.
Hello, my name is Atul Tripathi and I'm an honorary adjunct fellow at National Maritime Foundation. Welcome to this lecture on ESG analytics and green finance. This is the 11th lecture we are talking about green finance, sustainability, and we're talking about the strategies, the concept, the realities of green and sustainable finance in today's lecture. So let's start this show again. So the first thing when we start off with is, why does it actually matter? What is the reason for having this sustainable finance? That's the important focus that we'll be talking about, what the realities, what are the challenges, and most importantly, what is the role of technology? Because technology has become an integral player in every aspect of life. And in particular, when you look at the word of ESG and finance, and we have been discussing over and over again with various use cases and various approaches, we'll talk also on that aspect of life today. So the first thing that we need to address is, why do we even need something called as a sustainable finance, or why does it matter? Because you see, $900 billion of oil and gas assets of risks are becoming stranded under a 2 degrees centigrade risk rising scenario. That is as per Carbon Tracker. Now, we've talked about what the stranded assets are, and therefore you look at the valuation. If you look at it, it's a very large number, $900 billion. So sustainable finance is no longer about reputation. It's about adjusted returns, capital flows, and survival, but that is required in the climate-stressed economies across the world. Now, if you look at what is the world map here, you can see the percentage change in the economy per capita relative to the baseline with respect to the climate impact. So there is actually, the major impact is going to be coming to the countries that are on the lower side of the equator. If you draw the equator roughly, it's about approximately, I would say this one. So anything above or below primarily will be having, or the countries that are having closer to the equator are the ones who are going to be suffering the maximum. And this is where the bulk of the population across the world is also staying. Now, investors are actually redirecting trillions of dollars in terms of sustainable assets that they're looking at. Also, the ESG AUM is expected to reach about 1/3 of the global assets under management by 2026. That's a large number again. Then sovereign wealth funds and pension funds, they have now integrated ESG screening to the fiduciary duty itself. So it's no more about sustainability, is no more about CSR action. It's about capital reallocation, which is accelerating as we are heading towards the years, So green finances actually means cheaper capital, something we've been discussing over and over again, and re-stressing this point, because when you look at the companies with a credible ESG performance, they are enjoying lower rate of capital, something we've talked about. So, and then you have EU taxonomy plus IASB standards, and they are the ones that are driving your capital towards the climate-aligned projects. That also brings another point, is about the cost of inaction. If you are doing it financially, what is the inaction in terms of the financial factors you need to look at. Climate-related disasters are already causing about $300 billion global losses. This is as per Munich Re 2022 report. Continuing from the last lecture itself, carbon-intensive assets, they are facing massive write-downs in terms of impairments and policies tightening across the world, because the various the central banks that are requiring the banks and the insurers and the other asset management companies to handle this thing. Then you have the regulators and the central banks that are forcing the shift, because the ECB and the Bank of England and NGFS stress testing, they are being integrated in the climate pathways, so as to find the financial supervision, and then any non-compliance means regulatory penalties plus investor pullback. We have seen that something across the board in the past series as well. Then you have the sustainable finance, which is actually equivalent to your sustainable strategic advantage, because the firms that have embedded climate strategy to have a strategy around it are having a capture valuation premiums, your investor trust is going up, there's a resilience. So if you take the case of S&P has found that ESG leaders they're outperforming their peers by about approximately 20% during the market downturns. And that is why the sustainable finance is becoming a very, very important point. That brings me to another point, is some of the impact on terms of the across the board, the platforms that you can see. So if you look at this platform, which is talking about the economic impact of 2 degrees centigrade rise. So this platform is a pretty interesting one where you can play around with the data. And if you look at the -4%, where it will happening, not many countries, but then as you go to -2% to 1.5% to about, between anything between 1 to 0.5%. So these are the countries that will be impacted because of the negative impact that will be having because of the rise of 2-degree temperature changes. Therefore, you will see if you look at the positive, only the countries like Mongolia and some of the other parts in Alaska will be having the impact on the positive side, because obviously the kind of technology, the kind of environment that they live in. You can also play around this this website, or whatever you want to call it, platform. You can see it in terms of the 3D structuring of the globe, and you can see how much is the impact. So when you move to Russia, it says about 1.37 degrees positive direct economic impact if there is a rise of 2 degrees centigrade. Obviously, Russia being a very, very cold country, but majority of the countries, if you look across the world, they are not there they've got a high population density, and therefore the maximum impact will actually come around countries which are having high population densities, countries which are growing in nature, countries like China, India and UAE and Central Asia and Southeast Asia. They are the ones who are going to be bearing the brunt of it. So entirely Asia will be the one, and Africa will be the one who will be bearing the brunt because of the economic impact, because of the 2-degree rise in temperatures. This is as per the projected, these are projected numbers, and these projections are coming from Predit, Schwartz, and Tang, and Hülsing, and Allen. So this is a very important and interesting way of representation of data. Another thing that I wanted to highlight was about this no data, because we'll talk also about this aspect in today's session, countries where there is a lack of data or completely no data. So this is also an interesting aspect that I wanted to bring out on this map and or / platform, So when we look at another point on the similar lines, how is the capital markets impacting your price and climating risk? Because the markets are no longer treating climate change as externity, and they are doing directly embedded in the valuations, spreads, and the premiums. Equity multiples, if you look at carbon intensive firms, they have been traded at 20-25% valuation discounts versus the peers that are having a credible transition plan, that is as per MSI ESG Research 2022. Now, if you look at this graphical way of representation of the information, so S&P Europe 350, they talk about the impact on the wildfire, to cold wave, to heat wave, to stress, water stress, flood, coastal flood, and hurricane. Now, this is the various ESG related indices that have been there as per MSCI. So moderate climate change scenarios that will be happening by 2050. So what the impact that is going to be there. And this is an important point, because we need to understand how the capital markets will be performing based on the change in the climate, So one of the big things is obviously the credit market, the cost of debt, we'll look at it. The green bonds, they're enjoying a premium, while the lower yields for tighter spreads are happening. Carbon intensive borrowers, they're facing, borrowing costs as the investors are putting a transition risk altogether, something we talked about in the last session, transition risk, physical risk. And then you have the European, for example, the European utilities with heavy coal exposure, they are seeing spreads, the credit spreads are widening by about 60 basis points post EU Green Deal announcements, because the insurance markets is looking at the physical risk altogether, and the insurers are raising the premiums on the withdrawal in case of a coverage, when they're trying to give a coverage for wildfire, for flood, for hurricane prone zones. And the firms without resilience plans, they're increasingly seen as uninsurable or even high risk counters. Now that's a big thing. So insurance companies are looking at it from not only from the perspective of whether the premium should go up, it are also looking whether even that asset is worth the insurance if they have not taken these factors of both the physical as well as the transition risk into consideration. In the equity markets, the multiples and doubles discount rates you're looking at, because the climate-aligned firms, they're commanding valuation premiums due to resilience and the regulatory readiness, while the carbon-heavy sectors such as oil and gas, airlines, trade, they're trading at discounts reflecting the stranded asset risks. The ESG leaders, it has been found that they have outperformed during the downturn. So S&P 500 ESG index has outperformed by about 20% during the COVID-19 market shock that came around. And there's a systemic implication, because the markets, they are not waiting for regulations or the capital cost flows. They're actually reflecting the climate pathway altogether. That is where the boards are ignoring the rise that we see because of higher WACC and the asset write-downs and the diminished investor demand behaviors. So these are being taken as a part of the systemic implications altogether. So the board has also started to take into consideration. So, and then that brings us to another important point, the ESG investment. How is they performing? The ethical preferences to mainstream stay. That is what the strategy, that is what is happening, because ESG is no longer about values. It's about the value creation and the risk adjustment. That is something very important. So it's all about the risk adjustments now, because 79% of asset owners, they are integrating their ESG factors for risk-adjusted returns and non-ethical performance. This is as per PRI survey that has happened. And if you look out here, the performances across the board from 2022 to 2024 last quarter, and how they have been performing. This is as per the Morningstar, the Europe versus the US and the rest of the world altogether, and how they have been rising, the investments have been rising across the board. Because you see, from exclusion to integration, that is the pathway that the world has now started to take place as far as the ESG investment is concerned. Because earlier, it was exclusion of stocks or sin stocks, that they would call it, quote unquote, sin stocks, where there was alcohol or weapons or tobacco related, anything that would harm the humanity as a large community. Now they have started to take the ESG factors, because the factors have been embedded in credit analysis to valuations and portfolio construction altogether. Then there's another important point of risk-adjusted imperative, because this is about risk adjustment returns, and it's not about ethical performances, as we talked about in the way as per PRI survey. So when you look at it from the ESG factors, the climate, the governance, and the labor practice, they're financially material risks that one is looking at. For example, if you have a poor ESG governance, that means you have a higher legal cost, you have a higher regulatory cost, you have a reputational damage. Now, these cannot be recovered very easily. Similarly, the climate exposure is translating directly into a higher insurance and cost of borrowing and the capital all over again. And then you have the performance evidences when you look at it, because longitudinal studies have shown that ESG portfolios are matching or they are outperforming some traditional peers, especially the ones during the downturns, the ones that we talked about a few seconds ago regarding the coronavirus 19 ESG stocks, S&P 500 ESG, how it performed. Then you have the ESG integration, which is reducing your tail risks in the portfolios. So when I say tail risk, so if you look at any way of this thing, VAR risk, so you have a curve like this, which is called as your normal curve, and these are the tail risks that you're looking at. So they have been taken into consideration. Their ESG integration is actually reducing these risks. And then there's a mainstream adoption, because the institutional investors and the sovereign wealth funds and the pension wealth funds, they're treating ESG as a fiduciary duty now, more as in anything else. And the regulators, whether it's EU, SFDR, SEC, climate disclosure, they're accelerating the integration. Why? Because the ethical screenings, they were just not good enough. The initial ESG investment was more about the moral compass that one had, in terms of the organizations or individualistic as per board requirements and all that. Now it has moved towards the exclusion model. They did not perform. They would often lead to performing tracking errors and limiting the diversification. While when you have had an integration into the financial models, the ESG has shifted to risk identification, where you're looking at governance failures, which is equivalent to your fraud risk. You have labor issues, which is equivalent to your supply chain disruptions. You have the climate risks, which is equivalent to your stranded assets. Then you have the ESG ratings, which have become shorthand for a non-financial risk premium altogether, because the mainstream of the risk adjustment strategy has to be taken into consideration. And this is where the ESG factors, they are now directly being priced into credit spreads, to equity multiples, and the insurance premiums. One of the websites where you can go and look at the performance is this one. And when we go down to this website, you can clearly see how the countries have started to perform. So they have taken the economic accounting factor. Again, when we look at it, there are countries that have not implemented or there is no data altogether versus countries that are SEEA implemented. Now, you can see that thing, when you move around this map, you can see how it is being implemented, where it has been implemented, where there is a lack of data. Again, this is a 2D model on the terms of the economic accounting, and you can also do a 3D modeling. This, by the way, is as per 2023 report. So you can go there, you can see which countries have implemented, how they have implemented, you can look at the countries across the board, countries which have not implemented or there's a lack of data altogether. So that is why these factors have become very important. Another thing is from ethical performance or ethical measurements preferences, we have moved all the way to systemic risk reduction, which we've been talking about a few minutes ago. And that is why this has become such an integral part around this game. The managing the climate and the sustainability risk, as I said, is no longer about portfolio returns. It's about safeguarding the resilience of the financial system itself because of the physical risks, the transition risks that are associated. About $4.3 trillion potential global asset value losses by 2100 if systemic climate risks are unmanaged. That is as per OECD. Now, when you look at the entire flow of the risks that are associated with the physical risks or the economic risks or the financial risks, so there are multiple, nature, the degradation of the nature and the ecosystem, whether land use change or over exploitation to pollution to invasive alien species. There are two factors that are there. There's a physical risk and there's a transition risk, which feeds into the economic risk because of micro and the macro factors, which again feed into the financial risk systems because of the market risk, underwriting, liquidity, operational, all these. Again, they're feeding back into each other. And that's the loop that we are looking at. It's a complete cyclic loop. Therefore, you have this factor of climate and environmental risk management because you're trying to do your stress testing and capital buffers are being created. So the central banks, your ECB, your Bank of England, NGFS, they're requiring the banks to model climate risk and set aside capital around this because the green capex mobilization, it is redirecting your trillions of dollars into renewable energy, reducing your fossil fuel dependency, and it's leading to your lower risks in oil shocks. Physical risks in insurance markets, when you look at it from the ESG-linked insurance premium, is actually improving your resilience of critical infrastructure. Because of the financial stability and the safeguards, you have the stranded assets prevention and you have the liquidity and market contagion control and the prudential regulation. So if you look at the stranded asset prevention, you're looking at transition of finance, helping you firms to shift gradually and reducing this sudden write-off from the coal assets and the oil assets that are there to liquidity and market contagion control, where you're looking at ESG disclosure, which is improving your transparency so as to reduce your herding, your fire sale risks in bond and equity markets, to prudential regulations where there's a capital adequacy trust tied up with the ESG exposures, which is actually one of the important factors of the Basel style of reforms that have been required at this time period. So another important factor is around the social stability and the governance risk control. So you have the labor standards and inclusions and the governance screening, where ESG is helping reduce fraud, corruption, governance failures, things like that have happened in the past. One of the very famous cases is that of the Enron itself, or your FTX type systemic contagion that have happened in the past, So you have the inequality and risk migration of the risks, because social focused ESG is reducing your tail risk events from the instability. So take the case of the oil spill that might happen in the markets, Cross-border and supply chain resilience is being built into, because last time we talked about scope 3 transparency, which is very, very vital, and where about 70 to 90% of the data is to be captured and not being captured very accurately. This is reducing your hidden systemic shocks from the upstream supply disruptions, and the biodiversity protection is very important. Again, not from the talking shop, but when you look at it from the avoiding the agricultural collapse to food inflation, the shocks altogether. Then energy transition risk alignment, because the coordinated net zero strategies is reducing your geopolitical and resource security of the risks. So one of the platforms one can go and look and understand the interplay regarding the ESG investments. It can be in the platform of NGFS with the climate scenario, something we discussed last time around as well. Now, when you look at it from another perspective of the same information, so you have the historic net carbon dioxide emissions, and when you look at the scenarios that are there, explore the potential futures and their assumptions to, what is going to be the estimates of the courses of action in terms of delay transition to low demand, to all the way you have a transition risks to assessing your potential risks and opportunities when there's a rise of 3 degrees centigrade to the physical risks. And you can go down to this platform again. I've taken one of the factors into consideration, that is your carbon dioxide emissions. Now here they also take the very latest happenings across the world, the macroeconomic trends and the socioeconomic impact. So they have assumed the contagion. If you can see out here, they say that they assume a continuation of current economic and population trends and account for energy market implications of the war in Ukraine. So this is an important factor when you look at these kind of platforms, because from net zero 2050, that's about 1.4 degrees centigrade rise that is acceptable, to more transition risk, to more physical risk that is about 3 degree rise in temperature, to current policies where one is looking at. Because the decarbonization of the electricity market, electricity renewable will increase by 5-fold over the next 3 decades. And if you look at the other factors of the transition risk, the electrification, the buildings, industry and transport, then more than half of the energy of the buildings and industry and transport is going to be electric by 2050. Similarly, if you are looking at, say, storing and removing carbon dioxide, so there is going to be an industrial energy demand. It's going to be coming into bioenergy with CCS, that is your carbon capture and storage. CCS stands for carbon capture and storage. So around 2050, around 5 gigatons of carbon might need to be removed per year to reach 1.5 degree in a cost-effective manner, which is very important. The cost effectiveness of the factor that you need to take into consideration. Now, decarbonizing agriculture, forest and other land use, carbon dioxide in metric tons, carbon dioxide per year. If you look at the trends from 2050, from net zero 2050 to all the way down out here to about net zero 2050, about, so carbon dioxide emissions from AOFL sector can reach to net zero by 2030. Then you also have the physical risks across the world, and the rising mean temperatures, without the increasing ambition, and temperature increases by 1.5 degrees centigrade. Then in 2030, 2 degree around 2050, around 3 degrees around by 2100. That's the rising your mean temperatures. Then you have the heat and the labor productivity, something we discussed across last session itself. The labor productivity can decline by an average of 10% globally, and with the maximum impact having in Africa, it's minus 12.7 degree, to Asia, which is going to be about minus 10.3 degrees centigrade. Europe will be the least with minus 2.4, and Americas will be minus 9.41. Therefore, you see the impact if you look at all these factors, whether it's economic damages to direct damages to cyclones, to damages from tropical cyclones can increase by 47% to 1. When one looks at these factors, both the physical as well as your transition risks, so one is looking at the electricity generation in the transition risks, what will be the nuclear and the the renewables, whether in terms of the nuclear energy to biomass, to hydro, to geothermal, to oil and gas, from various scenarios that will be emerging across the board. So how would they be playing around? And then if you look at it and you coordinate of this data with the economic impact of 2 degrees centigrade across the board, so you come across the same kind of a scenario. So this is a very correlated information / data that is there. You can also go to the various countries, look at the various aspects as far as the increase in the impact on the economics when we're taking the various conditions. So take the case of, let's take this same case of Australia, mean air temperature rise and GFS impact, current impact policies. Then you can clearly see what's going to be happening, and we discussed all these things, last time around. There's going to be net zero, then to about 2 degrees, and then 2.5 degrees to about 3 degrees. And you can compare it with the warming levels to your, other factors, 2.5 degrees centigrade, what is going to be happening. These are the factors that are being playing around with the ethical preferences to move that's happening because of the systemic risk reduction factors. Another thing that we will be looking at is 4 different type of risk reduction strategies, from green finance to sustainable finance to blended finance to transition finance. Let's look at the first thing as first is the green finance, as a risk reduction strategy, because green finance projects can reduce catastrophe-driven GDP losses by 30% in climate vulnerable economies. That is as per IMF 2022 report, because green finance is not about charity, it's about risk hedging at a scale. Every green dollar deployed today is reducing tomorrow's credit default, stranded assets, macroeconomic shocks that have been taken into consideration. And when you look at it from the perspective of your green finance, there are basically 4 layers. You have the physical risk mitigation, where you're looking at an asset protection, level protection, to transition risk management, where you're avoiding your stranded assets, to market and financial risk controls, where you're looking at portfolio resilience, and then you have finally the systemic and sovereign risk reduction, where you're looking at macro level stability. So let's take the first one into consideration, the physical risk mitigation, the asset level protection, because the financing of the resilient infrastructure such as green buildings, renewable grids, smart irrigation, they are reducing your exposure to floods, heat waves, droughts, and leading to your lower insurance claims, while the reduction in the operational downturns is relatable to more stable cash flows, because green catastrophe bonds and resilience bonds, they allow governments and insurers to transfer their climate disaster risk to reducing systemic contagion. So, the World Bank 2023 says that about $1 invested in resilient infrastructure is saving about $4 in post-disaster losses. Then you have the transition risk management we're talking about in terms of avoiding the stranded assets. The green bonds and the transition bonds, they are providing you capitals to firms to phasing out the oil and coal assets, leading to smoother transitions and avoiding shock defaults. So then similar lines is the sustainability linked loans with KPI triggers, because the borrowers must meet the decarbonization milestone so as to reduce your credit default risk as firms adapt, and the portfolio rebalancing, where the investors are gradually shifting to renewables, to electric vehicles, to green technology, leading to lower stranded assets write-downs. Because as per IEA 2022 report, about approximately $1.3 trillion of fossil fuel assets are going to be becoming stranded by 2050 without any green transition finance that is going to be taking place. The third point in the similar lines is around the market and the financial risk control, the portfolio resilience. When you're looking at it you need to look at it from 3 different aspects: lower volatility of green assets. So anytime the green bonds are being traded, they are being traded at a pre-grenium, which is leading to slightly lower yields, resulting in your lower borrowing costs. Then there's a reduction in the default of the correlations, because the green finance investments are diversifying their portfolios away from the carbon heavy sectors that are failing simultaneously due to under-regulated or unregulated shocks that might be coming into picture. Then there was stability in the carbon spreads as well. Firms with a higher green financing are tending to showing lower credit spreads and higher investor confidence. Now, as per Moody's 2023 report, green bond issuers have an average of about 15 to 20 BPS tighter spread than conventional peers that you're looking at. So talked something in the past as well, reiterating that point. Systemic and the sovereign risk reduction at the macro stability level is another, and the final point that one needs to take care of when you're looking at the green finance as a risk reduction strategy. Because the energy security hedge you're looking at in terms of the lowering of, we're looking at in terms of renewable investment reductions, where the dependency is on a volatile fossil fuel imports, because you're lowering your inflation with the sovereign risk. And then you have the sovereign risk ratings were impacted because the countries with the high green finance penetration, they are showing lower sovereign borrowing cost as climate exposure risk as being priced. And the other factor on the similar lines is the insurance market stability, because the green finance is supporting your climate insurance pools, because they're resulting in the spreads that are of the catastrophic risk across the global reinsurers instead of hitting one economy at a time. As per IMF 2022 report, they say that countries with a strong green investment pipelines are facing about 30% less losses in terms of GDP after any catastrophe has taken place, because of the spreads that have happened in the financial markets that have taken various shocks into consideration. And that also brings me to another point on the similar lines, is the risk reduction strategy, and that is the sustainable finance. Now that has become a risk reduction strategy, because sustainable finance isn't the value-based It's not just value-based investment. It's a comprehensive risk framework that is where you're integrating your ESG factors into financial decisions, and this integration is reducing your idiosyncrasies, portfolio and your systemic risk across the economies. Because if you look at it from the environmental factor, the risk factor is out here, the carbon pricing to stranded assets, to physical risks that coming to the floods and the droughts, and the risk reduction strategies around the capital allocation, renewables and capital resilience in the infrastructure, green testing of the loan portfolios, to governance where you're looking at fraud and misreporting and regulatory penalties, to which is being linked all the way to your capital to governance, KPI investments and transparencies, well-governed firms. So you have MSCI, which is where the companies with strong governance is leading to 40% lower fraud incidents. So systemic risk, when you look at it, the market instability, the sovereign and the geopolitical shocks across the board, and because of the crisis fragility. So the broad ESG integration that is happening, because of diversification across resilient sectors, and the renewable investments that are coming in, leading to lower import dependencies. Now, as per Morningstar 2021, ESG funds had a lower volatility and outperformed peers during the COVID-19, the downturn that happened. Now, this is coming from two different sources. That one is the Morningstar, and the other one was the S&P 500 ESG index we talked about in the past as well. So you have the environmental risk reduction, as a strategy where the carbon pricing and the transition risk are being hedged, because there's a shift in capital towards low carbon sectors, which is preventing your stranded assets to pollution. Then the risk resource management, where you're leading to your financing your circular economic projects, reducing your liabilities from environmental fines or resource scarcity, to the physical risk buffer, where you're looking at the investments in resilient supply chains, to smart agriculture and lower disruption. So you have the bank stressed loans that are books that are being against the carbon taxes and the flood risk, leading to repricing of the credit accordingly. Because the social risk reduction factor that needs to be taken into consideration has a community and the reputational resilience, where you're avoiding your financing of the firms that have been linked to social harm, such as a child labor or unsafe practices. This leads to lower litigation and a boycott risk that might be happening, to the inclusiveness of the finance, because lending to undeserved communities to stabilize their local economics, that can lead to a reduction in the default clustering all over again. The microfinance plus ESG screening is leading to your risk reduction in default correlation in emerging markets, because the governance risk reduction is another important point, and the MSCI studies have shown that anybody is having 40% governance, strong governance is having 40% lower incidence in the majority of the frauds. Similarly, the systemic risk reduction, something we talked about. So all these factors are contributing to a big way to the sustainable finance factors. And that brings us to another point, and that is about the blended finance, where you're looking at de-risking your climate investment through public-private partnerships. So PPP is the model out here. So every dollar in public capital is blended finance, mobilizing about $4 to $7 in private investment for sustainable infrastructure. This is as per blended finance network report. And if you look at the investor type, to the instruments, to the vehicle type, to the users, there's a complete flow of the blended finance flows that is happening, because blended finance is existing because the climate projects in emerging market, they're carrying highly perceived risks in terms of the policy uncertainty or a forest risks or the long payback periods. That is leading to traditional private investors that are hesitant due to the asymmetry of the risk return. And then you have the risk reduction strategies that in the blended finance, where you're taking the guarantees, the public entities, the World Banks, the DFIs, they're covering your political credit risks, making the projects more attractive to private lenders, and you're leading to the first loss capital, where they're looking at development funds which are absorbing your initial losses, shielding private investors from the downside of the shock, to concessional lending. You have the public actors that are providing you, below market loans, and you have the reduction of overall finance cost to the technical assistance facilities, where you're building up the pipeline and you're strengthening your risk reduction risk for the private investors. Then you have the systemic market impact on the similar lines, where you're creating a track record of bankability of the green assets, because lower capital of asset, lower cost of capital means acceleration towards renewable energy, sustainable infrastructure, and most importantly, adoption of the finance. You're de-risking your fragile economy, which is leading to preventing of the capital flight and improving a long-term financial stability. So if you look at the World Bank and IFC, the blended finance structures in the sub-Saharan Africa and the solar projects they've reduced the private lenders' exposure, and they have achieved a leverage ratio of 1:6, that is public to private altogether. That's a very big change that has happened across the board as far as the blended finance is concerned. And therefore, we come to another interesting point on the de-risking. This is in terms of your financing of the transition finance we're looking at. Because the energy transformation is not about abandoning your carbon-intensive sectors overnight. It's about financing their credible journey to decarbonization, which is a very important factor when we often tend to dictate, to understand the subject. We tend to think that we're going to throw away all our carbon-intensive industries and sectors overnight and we're going to go all over green. It's not possible. You just got to refinance the entire thing so as to decarbonize, because $500 billion in transition finance is needed annually by 2030 to decarbonize hard-to-abate sectors such as steel, cement, shipping. This is as per IEA. And when you look at the journey that's been happening across, excluding China, they have excluded China in IEA's net emission report scenario by 2050 scenario. You're looking at low emission fuels to energy efficiency, high end use, grid storage, low carbon. And they have covered Europe, Asia, Africa, Latin America, and India as well as a separate sector. So they have excluded China because of lack of data that is there. And when we look at the various annual investments in the energy transition by 2050, this will be coming primarily in terms of the power generation to power networks, to buildings, to transport, industry, hydrogen, all the factors that need to be taken into consideration to the transitioning of the finance. Because why does it even matter? Because decarbonization of hard-to-abate steel sectors such as steel, cement, aviation, they're very, very difficult ones, and they're trying to essentially global for the net zero global targets. But the immediate investment is completely going to destabilize the economies, while the continued business as usual unlocks, locks in the emissions. So transition finance is the one that is providing a more practical approach towards this middle path approach towards your incentivizing your credible, your science-based decarbonization strategies, because risk reduction strategy for investors and markets is important, because credibility tests, in capital and is contagion on sectoral alignment with science-based interim targets to performance-linked instruments such as sustainability-linked bonds or loans, or adjusting your interest rate based on emissions and reductions to be achieved. Then you have the disclosure and the verification where you have regular reporting of the scope 1, 2, and 3 emissions where you're trying to reduce or greenwashing of the risks, and the policy alignment where one is looking at the integration with the national transition taxonomies and the carbon pricing frameworks to de-risk and regulatory uncertainty, because you have the systemic benefits where you're trying to prevent your stranded assets risk for industries that are critical to economic stability, supporting the workforce, the supply chain resilience during the industrial transformation, you're de-risking your global supply chains, which is leading to your stable pricing for the commodities such as steel, cement, and transport and aviation industries. So if you take the sustainability-linked loans, SLL, figures $5.5 billion has been tied up to GHG emission reductions. And you have the transition bond where you have JERA, which is Japan's largest utility, is raised about $300 million to support natural gas efficiency and hydrogen co-firing in the thermal power plants. So that's another way of transition risks that de-risk that one needs to take into consideration when one is looking at these factors. And then comes another one is, how do you reduce your risk premiums for the emerging economies, because there's going to be a lot of challenges in this sector. So now we're going to be looking at, how will you be reducing your risk premiums because of the emerging economies that has to be taken into consideration. Because emerging economics need about $1 trillion annually for green transitions itself, and the transition risk that we have to face. Because yet the financing cost is up to 7 times higher than the advanced economies due to perceived risks that are existing. With 90% of the increase in global energy demand by 2030 will come from these emerging economies, and yet they are receiving less than 20% of the clean energy investment. This is as per IEA. Now, if you look at the world map, it clearly indicates the kind of, the investments that one is looking at, and the green bonds that have been issued in the 23 jurisdictions including the 14 markets and of the G20 and the 23 currencies, all the way from Australia to China to Canada to India to US to Turkey, all across the board. And if you look at the world map, it clearly shows the kind of currencies that have been used to green finance and all the kind of investments that are happening across the board, because there's a structural inequality present in the climate finance, because the capital markets perceive higher default rates and due to political risks in countries in Africa, South Asia, Latin America, and this is resulting in inflating your interest rate. The currencies have been mismatched because the US denominated debt versus the local revenues, there's a currency mismatch so as to add the volatility. And then you have the ESG data availability gaps, which is becoming very important factor, because they're amplifying the perceived uncertainty, and that is resulting in your raising the financial premiums even further. So in order to have a risk reduction strategy, there's a need for a blended financial instruments such as MDBs and DFIs. They are providing you guarantees, the subordinated debts and the first loss tranches to lower private investor risks, and they have the currency risk mitigation factors. There are instruments like IFC's Managed Co-Lending Portfolio Program, MCPP, hedged FX ratios of foreign risks that are there. Then you have the sovereign green and the transition bonds, so as to help build the domestic yield curves and lower your systemic premium perceptions, Then you have the de-risking via the policy certainty, because the national ESG taxonomy, the carbon pricing and the climate-aligned industrial policy needs to be reduced for the regulatory uncertainty, because the systemic benefits of lowering the premium is going to unlock your scalable green infrastructure financing in high-growth economies, such as where there is a requirement for energy, transport, agriculture. This is going to prevent the debt distress cycles by reducing your sovereign debt sustainability risks. This is going to enhance your climate justice as well, because you're ensuring the countries most vulnerable to climate change, they aren't penalized, but there's a prohibitive costs that are there. So you take the case of Brazil, which is having a $2 billion green bond in 2023, that is 6.5 times oversubscribed. That means it was signaling an appetite for credibility and governance frameworks that are very strong. Then similarly, you had Kenya's blended geothermal financing, where the World Bank, along with the private capital, was there, and that has resulted in de-risking or cutting effective interest rates by 3 to 4 percentage points altogether. So this is where the importance is coming into picture. And if you look at the platforms across the board, then there are various platforms which is talking about how you're going to be de-risking your currency. Because when we look at these kind of information, so let's take the case of cost of capital of 50 megawatt to 100 megawatt solar power project by country-wise. This is from 2019 to 2024. So when you look at this thing, you have Brazil, you have India, Indonesia, Mexico, South Africa, and Vietnam. And one can look at the kind of changes that have happened. The median in 2023 was about 9.5%, and for Vietnam, which is represented in orange, by 2024 it was median was 9.4%. So it was a new entry altogether in 2023. You can see the data that is being displayed on this platform, the cost of capital altogether for the various countries across the board, with the median starting from 2019 to all the way to 2024. So you can look at the way the data has changed across the board. The cost of capital has changed. Now, that also brings us to another point, is the cost of energy consumption of different air conditions at different temperatures that have been set points, and the additional energy demand for the fans to reach equivalent of thermal comfort. So at 24 AC at 24 degrees centigrade set point, the energy consumption is about 1500 plus, to about 26 degrees centigrade when you have the set point, and so it's coming down. Similarly, when you can look at various other data points in this field, and you can look at the energy generation from coal in Hungary, which is as per January 2023 and May 2025, the amount of energy, the electricity generation from coal has started to come down in countries such as Hungary. The IEA total oil stocks in 2025, what was there in IEA and public as well as the industry perspective for North America to Asia Pacific to Europe. So how is the change is there? This is a very good platform to go around check the data, look at the importance of this, the reducing of the premiums of the energy market, how it is being managed across the board. This is an excellent way of looking at data and the information on the similar lines, the cost of capital for green energy altogether. That also brings us to another important point in the use of technology. So when you look at the importance of artificial intelligence and the GIS and the blockchains of the world, from carbon cuts to biodiversity, so what is saying, it says that the Natural Sustainability 2023 report says that AI-driven models can forecast biodiversity with up to 80% accuracy in pilot conservation finance program. This is the report that has come out because the impact of forecasting is actually mattering a lot, because the investors and the regulators, they demand evidence-based returns not only from financial institutions but also from your carbon reduction and ecosystem regeneration companies or industries that are involved out here. So the traditional models, they often underestimate or they are oversimplifying the complex ecological feedback loops that are there. Therefore, the artificial intelligence or the deep learning's role is becoming very, very important, because you have the carbon abatement forecasting, where the models are integrating your emissions data, technology adoption rates, your policy pathways, energy efficiency curves, so as to forecast your carbon savings. Then you have the biodiversity gains forecasting, where they're using geospatial imaging, satellite data, species habitat model, and you're trying to predict the ecosystem recovery and the resilience. Then you have the dynamic learning models, because the models then can improve as more climate and ecological data are collected and ensured more adaptive accuracy. And this is resulting in multiple applications that are being developed around sustainable finance itself, because there are green bond, the pricing and the certification, they have been tied up to projected and later verification is happening of the carbon and the biodiversity impact. The investment screenings, the banks and the funds, they're using ML driven forecasting to direct capital towards projects with the highest verified sustainability ROI, and the disclosure and the reporting is becoming important, because AI-based metrics is, they are helping to meet EU taxonomy or TCFD or ISSB reporting, impacting your reporting requirements. And therefore, the strategic insights are being brought forward because the deep learning isn't about forecasting numbers. It is about unlocking the credibility in sustainable finance, because you're able to align the capital flows in the real world impact. And this capability is crucial for the transition of the finance, so as to avoid greenwashing, as the investors, they are now demanding proof of the ecological and the climatic outcomes. Another thing that is coming around as a very important factor is the use of GIS, geoinformational systems, where you are globally a dollar invest every $3 of infrastructure investment exposure to climate hazard is resulting that increase, because as per World Bank 2021 reports, and every dollar of misplaced in floodplain or heat hotspot or future losses waiting to happen, because the climate hazard maps turn uncertainty into foresightedness. So the role of GIS is becoming an extremely important one, and this cannot be underestimated by any stretch of imagination, because the GIS, the hazard mapping is critical, because the financial market, they're often underpriced location-specific risks, such as the flood-prone urban corridors or climate-exposed supply chains. So the investors, they're needing geospatial risk overlays to avoid your stranded assets and ensure the resilient returns, because the type of hazard mapping one is looking at, say, flood zones, hydrological models that are combined with rainfall patterns and the sea level rise projections. We're trying to identify your future inundation risks, to heat maps, where you're looking at the satellite and the urban land use data, highlighting your hotspots vulnerable to rising temperatures and heat waves, to multiple hazard maps, where you're integrating flood, heat, drought, wildfire into a portfolio level climate risk as an atlas itself. And therefore, the multiple applications that are coming out is based on this thing in terms of sustainable finance, whether you're looking in terms of project screening. So the banks and the funds, they're trying to assess the project sittings that are there in the infrastructure, agriculture, housing, against the various hazard zones before committing to the capital. Similarly, the insurance and the reinsurance markets, when you look at it in terms of the hazard maps, they are being directly linked to the premium of the pricing and the risk pooling and the resilience bonds, because the innovative instruments where financing terms, they are being tied up to hazard mitigation and adaptive design, because this is resulting in strategic insights where the hazard mapping is shifting through the investment from reactive to more proactive so as to reduce the exposures while unlocking your new opportunities in resilient infrastructure, your green real estate and adaptive agriculture. It is ensuring that the sustainable finance is not just green, but also smart, clean, and location awareness. So let's look at a couple of platforms in this regard, which are playing around with this thing. So let's look at this platform where we're looking at the understanding of the various kind of disasters across the board. And when we look at in terms of the, the annual deaths from the disaster. So let's take the case of, say, earthquakes, across the board. You have the decadal average versus the annual average. You can also look at the injuries. So when we look at the deaths, it's pretty high. You can also have a lapse of the playtime that has been happening. So it's a pretty interesting website. So you can also look at the injuries that have happened now. Now look at the kind of playtime that again one can look at. So if I was to look, I can put this on the map as well to understand more in depth the countries that are such as Afghanistan to Turkey to Morocco to US and the areas in China, India, the ones India being very high prone with because of the Himalayas, which is the youngest mountains in the world, to Indonesia, to other countries. And then you can also look at volcanoes across the board. So where you can map it out, the importance of these maps are becoming very important. If I was to also look at the deaths that have happened, just as a case point, because the volcanoes, so one can see what has happened at various countries. So Indonesia has had 19 deaths in 2020. To DRC, which has had 6 deaths because of the volcano factor that I've taken into consideration across the board. You can also do a playtime and see how the map is being updated every time that this is happening. So you can do an annual thing as well, number of deaths from the volcano. So it does take a bit of a time. These maps do take a bit of time. So if I was to take all the deaths and the disasters into consideration across the board from 1900 to 2024, and if I was to do it, you can see the way it is happening from all the way from 1900s to 2024, and you can also look at every given time period for India, what is happening to China. So I can also, when I'm doing a playtime, I can put up a country, say if I take a consideration, just a country into consideration, take the case of China, across the board, what are the conditions, how did it happen, what happened. You can look at the deaths, you can look at the assets that were vulnerable and all that stuff. And therefore, that brings us to another important point, all unnatural disasters. You can look at it from the key charts that are available, the deaths that have happened, from the decadal deaths to the GDP, global disaster losses that have happened in the GDP. So let's take this into consideration, what was the losses from 1900 till 2017, then it gives you a complete understanding the economic damages because of the disasters that have happened because of floods, to droughts, to earthquakes, to storms, to glacial lake outbursts. Again, the same thing from 1960 to about 2022. They have mapped it out based on the information/data that is available. A pretty interesting website to go to and see and check around these things. Similarly, if you look at another factor, the cloud formation or the cloud fraction, let's take this into consideration. And you see out here again, starting from February 2024 to July 2025, what was the cloud factors that were there and the cloud fractions that were there. An important display of information on the maps so that the companies can, the insurance and the financial industries can understand what is happening across the board. From time to time, you can also increase or decrease, and you can download this thing. You can set various kind of conditions to play around with. So this comes from the NASA Earth Observatory, a very interesting and a very credible resource one would look at. These are the important platforms. Another important thing is on the Geo-ESG indices, which is localizing your green bond performance based on the place-based matrices. Now, again, the role of GIS becomes very important. Let me repeat myself. The role of GIS is extremely, extremely important in today's world for the finance world of sustainability, world of finance. And then you will look at it, all green bonds are equally green when they are invested in matters. How? Because the Geo-ESG mapping can differentiate resilient bonds from the stranded asset. This is as per OECD. So why does this matter? Because the geo ESG matters because traditional green bonds, they're often focusing on intended use of the proceeds, but not a real world place-based intent that is happening or the impact that is happening. Similarly, the solar projects, take the case of a solar project in the flood zone or a water efficiency project in water abundant region might be, this is going to be a complete misalignment with the ESG outcomes we are looking at. So defining geo ESG indices is becoming very important because these indices link your bond performance to geotagging ESG matrices such as flood resilience in coastal investments, water use efficiency in arid zones, biodiversity preservations in forested regions, and this is creating a localized ESG scoreboard for each investment because the applications, again, in terms of the investor differentiation, this is helping the investors avoid greenwashing by tracking where the impact is truly material to the risk-adjusted pricing. The bonds in the hazard-prone geographies can be priced appropriately. So you have the policy and the regulation factors because the regulators and the exchanges can now push for geo ESG disclosure standards, and this is giving you a strategic insights in terms of geo ESG indices so as to evolve your green bonds from your generic instruments into more precise climate-related and geo-tagged areas that you're looking at. By linking money flows with the placed sustainability outcomes, they are able to create more measurable resilience and accountability. In this regard, one of the important platforms one can look at when you're looking at the pricing of the geo based indices. Look at this case of this platform. So here you see out here what is happening is this platform talks about the use of the geotagged green bonds. They have covered developed markets, emerging markets, and supernatural markets across the board. You can look at from the issuer type. So if you look at the government bonds to 5 to 6 different entities, from financial corporates to non-financial corporates to development bank, government-backed entities, sovereign and the local government. So you can go there, you can look at the amount that has been issued across the board. When you play around with this information, you get a pretty good understanding. You can also look at it from the various, say, zone specific. Let's take the case of Asia Pacific as a zone. So then you can look at it from the perspective of the various issuance that has happened. Also on the climate, on the map, you can look at it from only from the Asia Pacific region. I'm sorry for this incorrect map of the map of India. Then you can look at the European factors and you can go to the various countries and see what has been happening around here. One can also look at the currency. So here I've selected Europe as a filter in the region type and the amount issued, number of deals you can look at. One can go there, look at the play around with them, various areas you're looking at, currencies accordingly. Similarly, a number of issuers that were there, how it has been changing. So that's another one. And the deal sizes are also being played around in the geotagged areas. So, if you take to all the global markets, then how has it changed to the number of issuers, to number of deals that have happened across the board from August till about July. So they keep on playing around with these numbers. One can play around. So if I was to only look at the developed economies as a whole, and then I only want to look at the emerging economies along with the developed economies, or only at the emerging economies, then they mention the kind of deals that have happened, number of deals, the global ways, and look, if I can also look at it from the, say, Asia Pacific. If I go to geographies, then I can see what is happening. So the total number of deals that have happened in China is 303, while in India about 10 deals have happened regarding this geotagged climate bonds that have been issued. Similarly, in Pakistan, it's been about one single deal. Saudi Arabia has done about 3. Then you have Turkey, which has done about 3 deals. So one definitely finds these kind of platforms very interesting and a very important ones to play around with. Another important point is in terms of the use of blockchain. So carbon credits have been reimagined with the blockchain verification of the trust in climate finance, because blockchain is creating an immutable audit trail for carbon credits and restoring trust for the investors as per WEF. So this is the complete flow of the carbon transition and tariffs. and reward for penalty calculations that have been happening, because the trust deficit in carbon credits is traditional carbon offset markets suffer from fraud, double accounting, and the unverifiable claims, and the investors and the regulators then they begin to question whether the purchased credit is actually delivering a climate benefit or not. And that's why the blockchain is becoming very important, because that is where you have an immutable ledger for credit issuance or transfer, for retirement, to ensuring the traceability, because every credit has a unique digital ID which has been tied up to a project, which is providing you real-time transparencies for investors, regulators, and public and audit flows. And therefore, the portfolio implications are going to be there in terms of the climate finance portfolios. They can rely on high-intensity credits, reducing your reputational and compliance risk, encouraging your cross-border investments, since blockchain is enabling your standardization, trusted tracking, and allowing your integration with DeFi platforms which have been tokenized, and the carbon credits can be traded like a green financial asset, because the strategic insights are coming because of the fact that blockchain is not only just a tech add-on, but a compliance and a confidence of the backbone for sustainable finance. And as ESG scrutiny is intensifying, the verified digital credits could become mandatory for the inclusion in the regulated climate finance portfolios. And therefore, the role of all the technology across the green finance is increasing day by day. That brings me to the end of this lecture on the lecture series of ESG Analytics and Green Finance. My name is Atul Tripathi, an honorary adjunct fellow at National Maritime Foundation. Thank you for your time.